How do banks qualify you for a mortgage? Remember the acronym D.I.M.E.S. D stands for debt, I stands for income, M stands for money, E stands for employment, and S stands for score, as in credit score. So let's work backwards on this. S stands for score, as in credit score. The banks are going to want to see a minimum credit score on FHA of 580 and on conventional 620. But the lower your credit score is, the higher the interest rate the bank's going to want to charge you. So to qualify for the best interest rates, you're going to need a 780 credit score. E stands for employment. They're not going to want to see any gaps in employment. So they're going to ask you for your last 2 years tax returns and your current pay stubs. M stands for money. They don't want you to borrow the down payment or the closing costs. So the bank's going to ask you for your last 3 months bank statements. I stands for income. The amount of money they're going to let you borrow is going to be based off of your monthly income. They're going to use 2 formulas to calculate how much money you can borrow. One is called the front-end debt-to-income ratio, and the other one is called the back-end debt-to-income ratio. Let's start with the front-end ratio. You're going to take your monthly income and multiply it by the maximum front-end ratio, which on FHA is 46.9% and on conventional is 45%. If you make $10,000, multiply it by 46.9%, that means you qualify for a monthly mortgage payment of $4,690, and that needs to include your principal, interest, taxes, and insurance. The same buyer going conventional will qualify for a mortgage payment of $4,500. And finally, D stands for debt. The bank is going to take a look at your credit report, add up all your monthly payments, and add that to your monthly mortgage payment, and you need to come in under a certain percentage called your back-end ratio. On FHA, it's 56.9%, and on conventional, it's 49%. Don't forget to like and follow for more.